Everybody is talking about how the stock market could crash in 2025.
I see a little bit more risk on the downside.
I think we're going to see the S&P go down 86% from the top and the NASDAQ 92%.
And even I did a video the other day on the downside risks in the market. But today, I want to explain how the stock market could explode higher. We could potentially even see Dow 100,000. And I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over, or actually let's ask the question, are stocks actually cheap? Let's look at a chart going all the way back to 1982 to today's date. On the left, we go from 0 up to 50,000. You guys know what this is. This is the Dow. And in the 80s, we start out, we're going up here quite a bit, but in the 90s, we really go up. And then we have the dot-com bust. We go up a bit, have the GFC bust, and then it just goes parabolic with the exception of 2018 and the cerveza sickness. So now we're here in 2025. Could we see it just go higher and higher and higher and higher and higher and higher, just like we have seen over the past, let's say, 10 to 15 years? Well, let's look at some key indicators to answer the question, is the stock market cheap right now? First and foremost, the Buffett indicator. This is just market cap of the stock market versus GDP for the United States. And as you would expect, right now we're at all-time highs, almost 200. And to give you some context, during the dot-com bubble, we were at around 150. Doesn't exactly seem cheap so far, but let's look at the Shiller PE. This is the average price to earnings ratio for the S&P 500. We use that as a proxy for the overall market. The Dow, we're kind of going back and forth here between the Dow and the S&P and NASDAQ. So right now we were at 38. Unfortunately, the average right around 17. And I would like to point out this 38 is higher than it was in 1929. Not exactly a good year for the stock market. And we're almost at the same levels we were prior to the dot-com bust. Now, I know a lot of you have heard about these first 2 indicators, but I'm sure none of you have ever heard of or thought about this next metric, which I think is the key to this entire video. That is market cap to M2 money supply. And those of you who watch my videos know that M2 money supply is just a measurement of the amount of dollars that non-bank entities have access to in the United States, just broadly speaking. It's an approximate number. Or for the layman, it's basically how many dollars are circulating chasing goods and services in the United States domestic economy, which would include assets. All right. Well, the total market cap for US equities, 55 trillion. Total dollars in the United States, as measured by M2, 21 trillion. So we would need to more than double the amount of dollars we have in the United States, and then take every single one of those dollars just to be able to buy the stocks at these current valuations. Let that sink in for a moment. So what this means, obviously, a lot of foreigners are bringing their dollars from outside of the United States, inside of the United States, in order to buy the stocks, to bring them to these levels, or to bring them to this level. So why is this the most important metric in this entire video? Because it explains what would need to happen, or one of the things that would likely need to happen to take the Dow from where it is today up to 100,000. Step number 2. So it's obvious the stock market is far from cheap. In fact, it's wildly overpriced based on historic averages. But like we said, that last metric is really the key. Just because the stock market is wildly overpriced right now doesn't mean that it can't get even more and more and more overpriced. In fact, we've seen that pretty much over the last decade. So let's go over some headlines from around the world and connect some dots here to determine the probabilities of the stock market continuing to go higher. Again, no certainties, only probabilities, right? All right, first headline right here from France. We see France's shrinking economy betrays urgent need to overcome budget wrangles. I'm not sure what budget wrangles are, but it doesn't sound like the French economy is doing that well. Next, we go to China, the second largest economy in the world. China trapped in a cycle of deflation. And just FYI, this is the bad type of deflation, not the good type of deflation. And just to give you another statistic, Chinese real estate has come down by roughly 30-35% over the past 2 years. That's a big deal because the Chinese real estate market was the largest asset class in the entire world. So the Reader's Digest version there is the household balance sheets in China have lost about $20 trillion of purchasing power just in the last 2 years. So how do you think that's going to impact aggregate demand? And is it any surprise they're potentially facing a deflationary collapse? Moving on to India, economy likely to slow in 2025 amid inflationary pressures and moderating demand. That's economic speak for demand is plummeting. European Central Bank warns of weak economy after delivering quarter-point rate cut. Canada, our neighbors to the north, unemployment rate at 6.6. Economists call for larger rate cuts. And keep in mind, this was a couple months ago. The economy has gotten a lot worse since then, and if I'm not mistaken, the unemployment rate is now at 6.8%, and the central bank up there is in fact cutting interest rates, but it's not doing anything to prop up the economy. German economy shrinks by 0.2% in fourth quarter, more than expected. They've been effectively having an economic contraction there for about 2 years. And everyone's favorite German bank, Deutsche Bank, shares drop after quarterly profit falls. Cost target scrapped. So not only is the German economy suffering, but the banking system, as you would expect, is on the decline as well. But let's not forget about Brazil, another huge economy. Here's a headline saying, how will Brazil's financial crisis evolve in 2025? And I'd like to remind everyone that their currency has plummeted relative to the dollar over the last few months. So what's my point? Well, it's simply, if you are a foreigner, are you going to invest in your local economy or in your local stock market? We can say that things are bad in the United States, and I am no fan of the fundamentals of the U.S. economy, that's for sure. But we have to look around the world and say, compared to what? And as sad as it may be, these foreign economies are even worse than what we're facing in the United States, and therefore it becomes like a TINA type of investment or trade. There is no alternative. Step number 3. Now let's go over what happened in 1990. Very important. We look at a chart going all the way back to 1980, and not to today's date, but as you would imagine, 1990. And on the left, we go from 10 up to, well, there's another 90. It's like a drinking game. But this is the Shiller PE for Japan. Remember, we went over this in step number 1, and currently the Shiller PE for the US stock market right around 38. And although that's much higher than the average at about 17, we see that these levels, as far as global stock markets, are far from unprecedented. Back in 1980, the Japanese stock market was around 20, using that same metric. And it goes up and up and up to the point in 1985 where it's right around 40. And then it goes straight up till we get to about 70. It churns a bit, then goes up to peaks in 1990 at right around 80. 80, a Shiller PE of 80. That is double where we are right now in the United States. So will our stock market get to the same insane levels that we saw in Japan? I don't know, but it's definitely possible. Another thing I want to add is the dollar, the DXY. So if you are a foreign investor, let's go back to what we were talking about in step number 2, and you've got options, and your domestic economy is falling apart, and by the way, your local currency is falling apart. We have seen the dollar go up over the last, let's say, 10 years against the Japanese yen, against the Malaysian currency, against the Brazilian currency, against the, obviously, Colombian currency, against the euro, against the British pound, against pretty much everything. So if you put yourself in the position of a foreigner, you've got two things there that you are considering. Your currency is collapsing versus the greenback, and your economy is collapsing versus the United States. So what are you going to do with your hard-earned money? Yes, it is true. Some people will probably go into Bitcoin. Some people probably go into gold and silver. But there is a significant percentage of people that will take their currency units, exchange them into dollars, and buy U.S. stocks. So here's the big question everyone has to answer. Is 2025 in the U.S. going to look more like 1929? Is it going to look more like 2000, 2001? Or is it going to look more like 1985 in Japan? I have absolutely no idea. What I'm trying to do with this video is simply present a different argument so all of us can consider as many variables as possible when we're doing our analysis as to what we think the probabilities are that certain outcomes occur in 2025, in 2026, and beyond. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here. I will see you on the next video.